Forget the big picture for a second, here's what is actually happening inside one gold company right now. Agnico Eagle Mines just reported numbers that should stop every gold investor in their tracks. Not because they are good, because they are almost embarrassingly good. And most people watching gold at $4,461 an ounce have no idea what that number means for the miners actually pulling it out of the ground. Most investors focus on the gold price and miss the real story. A few years ago, Agnico Eagle was grinding it out with gold sitting under $2,000 an ounce, fighting rising energy costs and labor shortages in northern Canada. Today, that same company is generating cash at a pace that would embarrass most S&P 500 names, and the broader financial media is almost completely ignoring it. And I think that silence is actually one of the most important signals in the entire gold market right now. Here is the first number you need to sit with. Agnico Eagle's all-in sustaining cost, that is the real fully loaded cost of getting 1 ounce of gold out of the ground, processed, and sold, came in at approximately $1,220 per ounce in their most recent quarter. Gold spot today is $4,461 per ounce. That is a margin of roughly $3,241 on every single ounce. Think about what that means at scale. Agnico produced around 878,000 ounces in a single quarter last year. Run those numbers and you are looking at nearly $2.85 billion in gross margin from one company, in one quarter. That is not a gold miner. That is a cash machine wearing a hard hat. Now here is where it gets interesting. Agnico Eagle's all-in sustaining cost has actually risen over the past 2 years, up from around $1,050 per ounce in 2023. Inflation in the mining sector is very real: diesel, explosives, labor, equipment. And yet the margin has exploded anyway because gold's price appreciation has completely overwhelmed the cost creep. In 2023, the margin per ounce was roughly $900. Today it is sitting above $3,200. That is a margin expansion of over 250% in less than 3 years. No tech company, no AI darling. Nothing in the S&P 500 has delivered that kind of operating leverage over the same period. And this is the part one want you to really lock in on, because it speaks directly to questions so many of you have been sending in. You have been asking, with gold already at $4,038, $4,113, now $4,461 an ounce, is the story over? Has the mainstream finally caught on? Here is the honest answer through the lens of this one company. Agnico Eagle stock, as of mid-2026, is still trading at a price-to-earnings multiple that is modest by historical mining bull market standards. In the last major gold bull run peak around 2011, senior miners were trading at 30 to 40 times earnings. Right now, despite margins that dwarf 2011 levels, the sector is nowhere near those multiples. The market has not fully priced this in. That is not my opinion. That is arithmetic. Let's go deeper into Agnico specifics because the details matter here. The company guided for full year 2026 production of between 3.35 million and 3.55 million ounces. That is roughly 1% of total global gold mine supply coming from a single operator. Their Detour Lake mine in Ontario is one of the largest open-pit gold operations in Canadian history, processing over 28 million tons of ore per year. Their Fosterville mine in Australia carries some of the highest ore grades of any operating gold mine on Earth, with certain zones running above 30 grams per ton, compared to a global average closer to 1 gram per ton. That is 30 times richer ore than what most miners are working with. When you have that kind of geological advantage at $4,461 spot, the free cash flow numbers become almost surreal. Agnico also holds a balance sheet that most companies in any sector would envy. Net debt has been falling consistently. Their dividend has been raised multiple times since the 2022 merger with Kirkland Lake Gold, a deal valued at around $13.50 billion that created the company's current scale. And here is a fact almost no one talks about: Agnico does not hedge its gold production. That means every dollar of price appreciation in spot gold flows directly and immediately into their revenue line. No complicated derivatives, no locked-in forward sales at lower prices. They are fully exposed to the upside. At $4,461 spot, that decision looks like genius. Now let's zoom out and ask what all of this actually means for the broader gold thesis, because this channel is not just about one company. It is about what one company reveals about the entire structure of this market. The federal funds rate is sitting at 3.63% right now. Real GDP growth in the US is just 1.5%. CPI is elevated, the economy is not accelerating, and in that environment, the opportunity cost of holding gold, which is basically the interest you give up by not sitting in bonds, is declining. That is a tailwind for gold price that is structural, not speculative. Meanwhile, I see the questions every week about Bitcoin crossing $65,000. And look, I understand the excitement. But here is the contrast worth holding in your head. Bitcoin is a narrative asset. Agnico Eagle is a cash flow asset. One of them produced nearly $2.85 billion in gross margin last quarter. The other produced a price chart. Both can go up. I am not dismissing crypto. But when people ask me whether gold and miners are still relevant in a world where BTC is at $65,000, the answer is in Agnico's income statement. And for those of you asking where gold ends 2026, whether we hit $5,000 or pull back, here is what the micro picture tells me. When the underlying producers are running margins above $3,200 per ounce, when production costs are manageable, when balance sheets are clean, and when the sector is still not priced at historical bull market multiples, the argument that gold is overextended is very hard to make with straight numbers. I am not giving you a price target. This channel never does that. But I will tell you this, the structure underneath $4,461 gold is not fragile. It is built on real, auditable, reported earnings from real companies with real mines. That is a different kind of foundation than most assets trading at these levels. The question is not whether gold is expensive. The question is whether the earnings justify the price. And right now, at least for the leading miners, they do. More than justify it. The lag between gold's price performance and mining equity valuations is one of the most underappreciated gaps in public markets today. Either gold pulls back to close the gap, or the miners re-rate upward. One of those outcomes is very good for anyone already holding physical gold. The other is very good for anyone holding quality mining equities. And in both scenarios, the person sitting in cash earning 3.63% while real GDP crawls at 1.5% is the one losing purchasing power quietly, every single month. That is the real story inside Agnico Eagle's earnings. Not just a company doing well. A signal that the gold market has fundamentally changed its operating conditions, and the broader financial media has not caught up yet. If you want to keep getting this kind of company-level breakdown with the actual numbers, not just the macro noise, subscribe to this channel and hit the bell. Every week we go inside the data that most gold commentary schemes write over. You will get the earnings analysis, the cost breakdowns, the balance sheet reads, and the macro connections that tie it all together. That is what this channel is built for. One more thing before you go. Before you act on anything you heard today, here is something I want to be straight with you about. I am genuinely just a student of this space, someone who digs into the numbers because I find it fascinating. Nothing here is financial advice. I am not your advisor, and the smartest thing you can do is verify every number I quoted directly against Agnico's filings. Do your own research, talk to people you actually trust, and form your own view. That is the only honest way to do this. And if you found the breakdown useful, drop a comment below with the question you want us to dig into next.